The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
I'm afraid probably impossible for you and I to now escape the impact of the intensification of the fighting between the US, its allies, and Iran. The Houthi groups yesterday that control much of Yemen saying they'll launch a military blockade of Saudi Arabian ports already. Tankers in the Red Sea turning back. The Strait of Hormuz effectively closed. Iran says at least 2 tankers are ablaze there. We know at least one, the crew had to abandon the ship earlier today. This is all pushing up the oil price. It'll push up what you pay for petrol and particularly diesel. It'll push up inflation, keep interest rates higher. There's a decision later this week. But at the same time, some claims that the impact of the crisis so far on South Africa has been relatively limited, mainly because of the reforms we've seen. Think of the inflation target being lowered, for example. The chief economist at Stanlib is Kevin Lings. Kevin, good evening. Thanks for your time. I mean, just a couple of weeks ago, oil dropped to $70 a barrel. Now closer to $90, past $90. If we stay in this zone, inflation, I presume, stays higher for longer, and so do interest rates as a result.
Stephen, yeah, that's exactly right. It was, I must say, looking good for a while. There was that memorandum of understanding between the US and Iran that was in place, and it was there for a couple of weeks, and during that phase, as you said, the oil price came down to 70 or just below 70, and it looked like it could hold on those levels. And then shipping activity through the Strait of Hormuz picked up quite a lot. At one point, there were at least about 30 tankers a day going through that strait. That's about half the normal amount, but it had been a meaningful improvement, and there was an expectation that a longer-term deal would be done. And so people were becoming a lot more comfortable with the outlook for inflation and interest rates, and then that all broke down. It's collapsed. And the fighting has got really intensive and really broad-based now. And the problem now, Stephen, is that if you said to me, how does this find a resolution? I can't tell you. There doesn't appear to be any negotiation going on. Nobody appears to be moving closer to some sort of agreement between the parties. If anything, it's broadening out to include more countries within the Middle East. And so you're now saying, well, it's very likely that the oil price remains at these levels or even higher for an extended time period, in which case we're going to see significant increases in our fuel price, particularly diesel. If you look at diesel, the daily under recovery is R3.80 a litre. Fortunately, at the beginning of this month, we were in an over-recovery position, so we're not going to feel the pain of that going into next month. That should still be okay, but if the crisis continues on for a few more weeks, then the month after that, we're going to see a hefty both diesel and petrol price increase, and then we are locked into much higher fuel prices. The inflation rate will move higher. It's already moved to some extent, but it will go to 5% if the oil price stays where it is, and the Reserve Bank will feel compelled to hike rates further. Already there's an expectation this week they could hike 25 basis points. The Reserve Bank is adamant on achieving that, the 3% inflation target. So this is a very unfortunate change in circumstance, and everybody else in the world is in exactly the same position, unfortunately.
I mean, if you're the Monetary Policy Committee and you're thinking of 25 basis points and you see how intense the fighting is, I mean, you might be tempted to front load it and make it 50 because you actually do need to do something quite urgently.
Now, the problem with 50 is that you're going to shock the system, and you may just, in the end, cause a huge amount of hardship within the economy and significant weakness that is probably, to some extent, unnecessary. Because remember, what you're trying to do, you can't control the oil price or the petrol price. You're trying to control whether or not these price effects get passed on. And quite frankly, we haven't seen a lot of pass-on effect. I mean, we've gone through a phase where the fuel price was significantly higher. And if I look at evidence of second-round effects, it's very modest. So we've actually so far been okay-ish. Yes, of course, the inflation rate is 4.5%, so that's too high. But if I go back to previous times when we've had a similar type of event, inflation's moved up a lot quicker than what it's done at the moment. So I don't think 50 basis points is justified. I think the 25 is to keep sending the message that we don't want these fuel price increases passed on, and we're trying to be adamant about controlling inflation. And yes, that's not a bad message to send. And while I'm just on that, I must say that the feedback we get about the credibility of the Reserve Bank internationally is phenomenal. And there's no doubt in our minds that the credibility of the Reserve Bank is helping the rand. In other words, foreign investors understand that the Reserve Bank is adamant on the inflation target, will do what's required in terms of interest rates, is independent of the government, and that gives us foreign investors a lot of confidence, and so the rand benefits effectively from that confidence.
Busisiwe Mavuso, the CEO at Business Leadership SA, suggested yesterday that the impact on our economy would have been much worse without the recent reforms. And I think she's talking more about the lower inflation targets and that kind of thing. Do you go along with that? I mean, is it helping to protect the value of the rand for a start?
The inflation target, yes. The introduction of the target, the way it was done, the fact that we were at the target before the Iran crisis started, so we'd made significant progress. The fact that the Reserve Bank was and is adamant about achieving the target, and that message has come through. The fact that they haven't immediately cut interest rates because we were at the target. There are a number of reasons why, and that goes across very well internationally. And South Africa, honestly, is one of the most credible central banks within the emerging market space, and that's a phenomenal achievement. And I think, the rand benefits. Is that cushioning us to a huge extent? I would say not really, as much as what it might suggest. What's cushioned us is, without being too cynical, is we've been shopping. If you look at the two-pot withdrawal out of the retirement funds, they were phenomenal last year. And last year, retail sales grew by 3.7%, yet the economy grew at 1.1%. And a lot of that retail spending was on the back of the two-pot withdrawal. Yes, inflation was a bit lower, so that helped real incomes. But we shopped like crazy last year. And that undoubtedly gave us a sense of resilience in the economy. This year, it's slightly different because interest rates are higher, and obviously inflation now is moving up, so the consumer is going to come under increasing pressure. Does a stable rand help us? Yes, but it's not an answer for us. We've got what we call the terms of trade have deteriorated, which means the gold prices come down, the platinum prices come down. So we're not getting the same benefit that we were getting, 6 months ago or a year ago for high gold and platinum prices, and therefore spectacular export earnings. And the government will find, as 6 months rolls on, that their tax revenue isn't quite as buoyant as what it's been. So no, I don't know that we should look at the situation and say simply because we've got a low inflation target, we are reasonably unscathed. I think there are other reasons why we're unscathed, and I would worry that some of those factors are going to dissipate now over the next couple of months.
Kevin Lings, thanks very much indeed. Very sober conversation. Chief Economist at Stanlib, 21 minutes after 6.
702.
702.
Stephen is on X.
At Stephen Grootes.
The Home Affairs Department saying it's now opening a new trusted employer system. So companies that go through a selection process, are pre-selected if you like, they'll be able to apply for visas for workers from other countries with specific skills to enter the country, basically make the whole thing quicker and easier. Leon Schreiber is the Minister of Home Affairs. Minister, good evening and thanks for your time. How is this going to work? What does a company have to do to qualify to be a trusted employer?
Good evening, Stephen, to you and the listeners. So until the 4th of September, companies have the opportunity to complete an expression of interest. They will find the link to the Trusted Employer Scheme's Phase 2 program on the Home Affairs website. We've introduced this online portal for the first time, which in and of itself is an innovation compared to the previous round of intake. So it makes it much easier, and I understand there are already a number of companies that have actually already completed the expression of interest, which is really encouraging. But effectively, once the information is provided, there are 3 different pathways that companies can follow in order to reach the number of points that are required in order to qualify for the scheme. The applications will be assessed by an interministerial panel, including officials from Home Affairs, DTIC, as well as Labour. And I think what's worth mentioning is that in this particular sort of next level of this trusted employer scheme, we're really focused on infrastructure projects, on companies that are headquartering in South Africa, as well as a really innovative focus on financial services to try and reshore some of the financial services that have left the country in recent years. So that's basically the process that companies can go through.
Companies that are based overseas, so foreign companies that have offices here, is it the same procedure for them if they want to bring in a South African CEO from Beijing or something? Are they able to do that?
Yeah, so one of the pathways that you'll find there is really an incentive and an encouragement for businesses to move headquarters or regional headquarters to South Africa. So the ideal would be for a company like that to be incentivized to actually bring some of their business in the region to South Africa. And really, in exchange for that, we then, linked also to minimum investment values, as well as ensuring that 60% of the staff employed by this business are South African citizens or permanent residents. In exchange for meeting those criteria, we then guarantee them quicker turnaround times on work visas. We drop some of the red tape requirements that have traditionally really clogged up this process. And as the name suggests, we recognize them as being part of this broader trusted group of entities. And as I say, the first phase of this has been in place for the last 2 or 3 years. It's worked really well, but the clamor has really been coming from the business sector to make exactly some of these changes now, recognizing some of these key sectors, further simplifying some of the processes, introducing digital platforms. So this is really a response to something that the market has wanted. And as I say, I'm really delighted by the response and the number of companies that are coming forward.
Is there, once you have once you have that status of trusted employer, is there still a definition of what a skilled person or a special skill or whatever is? You can't just bring in anyone, obviously.
Well, you'll remember that we introduced the points-based system for work visas just after I came into office in 2024. And that really outlines what kind of jobs we're looking for here. So the Gazette itself also makes the point, this is not about unskilled labor. This is not about low-wage positions. I think the current criterion is positions above an annual salary of 900,000 Rand. So it fits within the existing points-based system. But I think one of the key benefits, as I've said, some of the red tape is reduced, but also we take the applications in batches. So, sometimes we have this problem where even a family member might be applying with a highly skilled person, and, their spousal visa gets rejected, which doesn't make sense. So we're taking it as batches and making sure that all of these applications are processed collectively. So, yes, indeed, there are still applicable criteria. The Gazette makes it clear what this is for, highly skilled individuals. But I think the processing thereof just becomes so much more efficient and prevents these kind of perverse outcomes that sometimes, you can't attract a CEO if they can't bring their family. So these are some of the obvious things that we're solving.
So someone who is a spouse, who is a working spouse of the CEO, would they be able to come here too under this system and maybe work in a different area or not really?
Yeah, I mean, you can't split up a family if you're trying to attract highly skilled people. So that's the principle. Of course, the spousal visa is also a category in and of itself. So the application is still processed against the particular criteria for a spousal visa. But in principle, if someone meets the requirements for one of these highly skilled positions, it should not be a problem. The spousal visa does have its own process for getting a work endorsement. It's actually something that we've proposed to change in the revised white paper that Cabinet approved earlier this year, where we think the work endorsement process itself should be streamlined, because, as I say, you actually, you're undermining what you're trying to achieve if you don't view this as a bundle of applications, a family unit, or the like.
Leon Schreiber, thank you so much. The Minister of Home Affairs. Really appreciate the time on The Money Show. 27 minutes after 6.
The Money Show.
The markets.
Anthony Modasani is the senior equity sales trader at Absa CIB. Anthony, good evening. Kumba, I suppose a result which really is quite disappointing. Their headline earnings will be down possibly by around 40%, or the EBITDA will be down 40%, just the way the numbers have panned out from last year.
Yeah, Stephen, thanks for having me. Always good to be on the show. It was a bit disappointing. The stock down 5% on the session. They said they had resilient operations despite severe weather conditions. Production declined roughly around 3% during the period due to an exceptionally heavy rainfall. So I think, investors weren't a little bit happy about that, and it looks like their profitability is also under a bit of pressure. They guided EBITDA to be, looks like a 30 to 35% lower year on year. So, and that was also due in part to a stronger rand. So it seems like a little bit of negatives outweighing the positives at this juncture.
An update from Sasol. Secunda seemed to be doing very nicely. Natref had a strong year. Their destoning project seems to be working, but I think some of this was expected.
I mean, especially when you see a rally in the oil price of 2%, as like tensions between the US and Iran continue to increase there. We didn't think there were any sort of major negative surprises. The company did warn about inventory build in field in the fourth quarter, which would have impact on their working capital and ultimately their free cash flow. And that's sort of been what's key, is that you've had a high oil price that sort of helped free cash flow down the line. Now, all of a sudden, when you have this sort of inventory build, that sort of starts to have a little bit of a negative impact there. So I think, this is sort of just balancing, the expectations. There wasn't, like I said, there wasn't anything overly negative. If anything else that could have been mentioned, the company did mention elevated field imports into South Africa as a competing factor, which can impact their sort of sales volume. So perhaps just slightly a bit more negative than anything to get excited about. But, let's wait till the trading statement later.
Aspen seemed to have a really tough day. They were down nearly 7% on the day. There was an update from them in the last 24 hours or so. What's happened?
So it's quite surprising, right? Yesterday we had news out that Canada approved Aspen's, basically their GLP-1 for the Canadian market. So that's your generic semaglutide that's sort of taken the world by storm, right? While it's a positive development for Aspen, I think what we also need to remember is I think early on, like roughly around the 9th of July, you had Dr. Reddy's, which came out with an announcement saying that they've halted the commercial production of its generic semaglutide after an unknown impurity in it's the API. It's called the active pharmaceutical ingredient. So they are Aspen's sole supplier of this API. So, that it sort of hamstrings Aspen at this juncture in terms of being able to distribute any of these GLP-1s, And if you also just think about your sort of increased competition that you have in, I think Novo Nordisk has said that they're going to be also distributing a generic Ozempic into the SA market sometime in the second half of this year. So, increased competition and you're not actually able to distribute any of the GLP-1s, I think just makes it for a tricky environment for it. So, look, I'd also just give context. Aspen's up 30% year to date, right? It's had a really good run. So I just think, you've also got investors that are happy to take profit at this juncture. Wait for the results. Wait to see when they'll be able to distribute GLP-1s.
Thanks very much indeed. Anthony Modasani is a senior equity sales trader at Absa CIB. No, that market is just moving so quickly. Just after 6:30.
7:02. Stephen is on The Money Show.
6 to 8 p.m.
13 minutes to 7 the time. Well, you heard those three voice notes earlier. You heard from P, you heard from Tato, you heard from Busi. All of them very much against home ownership. Bit of a scam, said one. Too expensive, said another. Not sure it was really a good investment, said a third. Hayley Ivins-Downes is the managing executive for real estate at Lightstone Property. Hayley, good evening. Money Show listeners are not alone, are they? Plenty of younger people are looking at property and going, actually, I don't see what the point of this is.
Hi, Stephen. Thank you. And yes, our data is actually pointing to that. It is supporting that. We're seeing kind of a drop in an age of what we're seeing as under 35s. And, when we look at kind of the population of under 35s, there's 37% of the population is that age group, and we're seeing buyers are only 7%. So it certainly is pointing towards a drop in terms of where people are focused. And And yeah, over 20 years, we've seen a drop from 44% to 30% in terms of the buyers under 35. So there is definitely an impact that we're seeing.
Is it an economy? Is it that property is not actually the investment that it was? I mean, I was always told property will appreciate. I bought a house in Joburg. Thanks a lot. Is it about something else?
So I think there's a whole mix of factors. I think one of the elements is definitely affordability. So what we're seeing is property prices have really increased compared to your household incomes, just definitely not kept pace with what the property prices are in certain areas. And then obviously from an affordability point of view, you're looking at the economy and you're looking at high level of unemployment, rising living costs, stagnant wages, the cost of owning a property and buying a property versus renting a property. So certainly seeing all of those factors that are compounding it.
Are we very different from what's happened in other parts of the world? I know in places like the US, the UK, parts of Europe, Europe's always had a slightly different home ownership culture. But younger people seem to just generally not be as keen. I mean, I don't know if something's happened to sort of homes as an asset class, or if there's maybe just a shift in the way people want to move through the world.
Definitely. I mean, we had a look at the UK as an example, and property ownership of 25 to 34-year-olds, whereas at 59% in 2000, that has dropped to 39% in 2023. So there's definitely a drop in the UK, and Australia's showing the same. Ownership in properties has also dropped from 61 to 43 in the age group of 25 to 34. So it's definitely a worldwide phenomenon, whether it's the prices of houses that has increased kind of beyond what people can afford, or whether it's the lifestyle of being able to move and without being restricted to one place. I think it's definitely a mix of all of those factors.
At the same time, you had another report out this week talking about how the number of foreign nationals who are buying houses priced above 20 million rand and above has really increased. I mean, 40% of those sales now are to foreign nationals. What's the big pull? And for goodness sake, Hayley, it can't just be Cape Town.
So I just think that there's an affordability. From a foreign national point of view, you buying with euros, you're buying with dollars, you're buying with pounds. It's a different market. They can afford all of these luxury households in the Western Cape, but it's not just in the Western Cape. It's actually quite interesting if we start kind of looking broadly across the country. Foreign ownership is actually mostly in Johannesburg. 15.3% of foreign ownership is in Johannesburg. So that is definitely kind of featuring as well. So I think it's definitely just the lifestyle in certain instances and what money can really get you with the foreign currency.
Are people, foreign nationals, buying homes to use as holiday homes? Are they buying them as investments? Or is social media right when they say that Cape Town's being bought up just for Airbnb?
I think it's a whole mix once again of that. I think what we're finding is that foreign nationals buy to live. Some of them buy to be here for 6 months and to be in Europe for 6 months or in the UK for 6 months. And then once again also to rent it out because they know that there's an affordability and there's tourism. They can earn some really good revenue, and especially in a place like Cape Town where Airbnbs kind of make sense. So I do think it's a mix of all of those.
Thanks very much indeed. Hayley Ivins-Downes is the managing director, or the managing executive rather, for real estate at Lightstone Property.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
6 minutes to 7. Well, it looks like the city of Joburg and the National Treasury may be getting on the same page about Joburg's finances. The Finance Minister Enoch Godongwana and the Joburg Mayor Dado Morero meeting today. Remember that blistering letter Godongwana wrote to Morero? He said the city had an unfunded budget, should not go ahead with a 10 billion rand salary increase to SAMWU members. Also, Joburg, one of the cities where the National Treasury has withheld a portion of its equitable share payment because of the budgeting issues. So Godongwana and Morero, they spoke briefly outside their meeting today.
I had a meeting with the mayoral committee and some senior officials. We've had a successful meeting. We've developed a nice program, and I'm coming back in September to follow up on progress that on those issues that we've agreed upon with the mayor and the mayoral committee and senior management I think we're going to succeed in turning Johannesburg around.
Yeah, thank you, Minister. And we had a very progressive meeting, touched on the issues that the Minister had raised before and what progress we have made as the city. But what was key was also to take the Minister into confidence about the current financial position of the city so that he could also know what interventions he would need to make to ensure that we succeed. He has also made a good commitment.
Okay, so Dada Morero, the Joburg Mayor, and the Finance Minister Enoch Godongwana speaking there. Julia Fish is the Executive Director of Joburg Can, also on the steering committee of the Johannesburg Crisis Alliance. Julia, good evening. Look, I wasn't in the meeting, and I presume you weren't, but there's been various meetings. There was that blistering letter from the Minister. Do you get a sense the Mayor and the Minister are slowly beginning to see eye to eye on Joburg's money?
Good evening, Stephen. To be honest, the statement is incredibly frustrating because when you really look at the numbers, the city might have been honest about their current financial situation, but I assure you they were not honest about what they're doing to turn it around because the plans they got on the table don't actually match the budget that they're throwing at those plans.
In other words, the budget is still unfunded. They're expecting revenue they won't get.
It's not only on an unfunded basis. So they've adjusted their collection rate to line up more closely with what they are actually collecting. But when you actually look at how they're getting that money in, we're seeing massively inflated bills. We're seeing huge problems when it comes to their billing, their debtors book, and how they're paying their creditors. They've also gone back from what I've heard today on not raising the sanitation price for sectional title properties, which is going to cause a big problem. They also now have a problem with their tariffs. So they haven't technically been approved by NERSA. There's a push that people might actually be looking to get refunds from the city for the tariffs they've charged. And then at the end of the day, they're not able to collect at those rates. But the major issue here is what they keep putting in front of Treasury is these turnaround strategies. What they're claiming they're going to fund Joburg Water, City Power, pick it up to be able to really invest in their infrastructure. But when you look at the operating budgets that they've allocated to these people, it's not enough and it's not in line with what those entities need to be able to run.
They keep saying that they're investing in the major water problems, the major electricity problems. And I realize that even you can be spending money on those problems and service will still get worse for a while you're doing that. But what you're suggesting is there'll be no improvement over even the short or medium term.
There's no urgency here. So even the turnaround strategies, while honest, like he's being honest about the financial state of the city, they're not urgent enough. And when we really look at, for instance, City Power, the money that they need to be able to invest in infrastructure, let's take Economist, the major pumping station that feeds most of the west side of Joburg, that project has been cut because they haven't got enough money to do it. And these are the urgent things that we've been told for 3-4 years now were going to come through in this budget, and they're just not happening. And it's quite clear that really when it comes to talk and the actual money coming through, it is just that. It's all talk.
So the president famously said that he wasn't happy with the state of Joburg. There was the meeting, there was the setting up of this group, which I think you're on. All of this was supposed to mean that the presidency was sort of involved, and yet there's no intervention from the province. There's no intervention from national government. The Sulga CEO says he's against an intervention. Is there a kind of hands-off Joburg? I mean, the only person who is seeming to do anything is the finance minister.
That's what we were hoping for, is that these strong letters from the finance minister, even though we don't necessarily support the withholding of the equitable share grant because that's supposed to fund indigent households who genuinely can't afford services, that money is still being used to pay bills, not actually cross-subsidized like it's supposed to. So the only person who was standing up was the minister. And now it seems that he's been placated by the same stuff that we've been hearing for years that, again, is not actually bearing fruit on the ground.
Julia Fish, thank you. The Executive Director of Joburg Can, a member of the steering committee of the Joburg Crisis Alliance. It's incredible to sort of realize, along with all of this, that around 45% of our councils passed unfunded budgets. When I read that, and I actually didn't realize it was that high, but when I read that, I was like, wow, people are living in sort of cloud cuckoo land. There's this idea that the money will be fine. It won't. That's why you have to have a funded budget. Really is incredible what's happening in local government at the moment. You're with The Money Show at 7 o'clock.
7:02.
7:02.
Stephen is on The Money Show.
6 to 8 p.m.
Well, there's the Defence Lekgotla. You heard a report about that in EWN, and there was a comment yesterday by Parks Tau, the Trade Industry and Competition Minister, that we need to urgently reinvest in our defence sector. A fascinating number from it. The amount of money spent by the defence sector on research and development was 6.1 billion rand in 1989. It's 500 million rand now. I found that figure really hard to believe, actually, although any reminder of what was going on in South Africa and Southern Africa around 1989 might remind you of why that figure was so high. Ricardo Teixeira is a defence analyst, joins us now. Ricardo, good evening. Firstly, are those numbers legit? I mean, were we really spending over 6 billion rand on research and development in the defence sector in 1989? I mean, to account for inflation, it must have been a huge amount of money, and yet some people would have said there was a sort of military complex running apartheid South Africa at the time.
Evening, and thank you very much for having me. Yes, those numbers are legit. At the time, the defence spending was on its way to about 5.5% of GDP. Today, it's sitting at 0.7%, with the majority of that share being for salaries, and very little has gone towards research and development in the last 30 years. But yes, at the time, that was quite a bit of money. If you adjust for inflation and the rand's change over time, it's a lot different. Also, putting into perspective what the minister also added in his speech, that acquisitions from the domestic industry in the same financial year was 26.2 billion rand. In 2017, it was 850 million. Even if you don't account for inflation, if you just take that 26.2 billion rand budget, that is now around about 45% of the current budget, whereas that is, if you again look at the current budget's segments, that's not even what we're spending on salaries. What we spend on salaries today is higher than 26.2 billion rand.
Sure. Okay. The reason for this big change really has been, and we can argue about this and that, but has probably been 30 years of peace that we've lived through. And I mean, it's an awful thing, but that's changing now. It kind of feels sometimes that everyone in the world is rearming. The scale of investment that we need in our defense sector to kind of just get back to some sort of level, I suppose needs to start with a needs assessment. And even that's quite a complex thing to do.
Yes, I mean, ultimately, before you go shopping, you need to know what you're shopping for. And to know what you're shopping for, you need to understand what equipment you need. And for that job, you need to know what your job is. You know, you can't go and say, I'm going to buy 10 Ferraris, but you're going to be doing a rally race in the Dakar. You know, we first need to decide what sort of military South Africa needs. And for that, you need to understand the political objective. So ultimately, the policy needs to be set by the government, and they need to first define what exactly SANDF's purpose is. And this has been a fundamental failure of the government since 1994. We see now that the military is being used to assist the police, to do border security. And the Minister of Defence I said that the Defence Force is a partner in combating youth unemployment. But nowhere along the lines are they saying that what we have here is not a welfare force, but a warfare force. And before we can start shopping and trying to turn the Defence Force around, we need to accept the reality of what the Defence Force is supposed to do, then structure it accordingly, then equip it appropriately.
So some things are pretty obvious and you can probably do without necessarily having a tightly defined political mandate. So we probably need more trucks. We make really good buckies in South Africa. We could do with some of those. We also need the capability to move our people around first the country quickly, but then also, and we would probably buy transport planes to move them to, some part in Africa where they're needed for peacekeeping or something like that, or if we needed to project force in anything. And I imagine everyone will still go back to a Hercules C-130. I'm no expert, but from what I understand, they're still fighting. The one thing that might be a bit more complicated, and which I understand is a really important piece of kit and is an attack helicopter, because you can do all sorts of things with attack helicopters. To buy those or to build those requires an intense investment.
Yes, it does. But if I can stop you there, the most important weapon on the battlefield is the radio. If you can't communicate, you can't shoot, you don't know where you are, you don't know where the enemy is, you can't call for supply, you can't call for support, you can't really do anything, you can't coordinate. SANDF still relies on communication systems and software that was programmed in the 80s and early 90s.
Wow.
And is way outdated. So before we can start talking about rebuilding the Roy Falk and getting a Roy Falk Mark II going, SANDF needs its own secure IT and ICT infrastructure. It needs payroll software that was not programmed in languages my father learned in high school. It needs to stop using Gmail. It needs to understand that AI isn't just using ChatGPT. But yes, there is an immense amount of investment required, and I'm glad that you picked up on the logistics there, because that is a fundamental military capacity that we do not have. All warfare is essentially logistics. I mean, they say that amateurs talk tactics, professionals talk logistics, because ultimately what you're trying to do is take a bullet from a production line and deliver it all the way to the battlefield and into the enemy. And, if you want to move a division, you need 10,000 tons, which means you need 10,000 one-ton trucks, or you need 2,000 5-ton trucks, or you need 3 ships, or you need 10 trains. SANDF doesn't have any of that, but most importantly, its fundamental ability to communicate effectively is not there.
If I remember, there was a story about the Air Force and the sort of security sector that they have, where people couldn't be in the room for longer than half an hour because the air conditioning didn't work. Ricardo, everyone, big discussions this week. Let's invest in the defense, etc. But I mean, the arms deal from the 1990s, I think, has a strong political hangover because of the corruption, Shabir Sheikh, Jacob Zuma. And I realize everyone's talking this week about why we need to invest in the military. And obviously there is a strong case from what you and others say we do need to do that. But the moment you say to a voter, it's either this or social grants, well, then everybody thinks again. Do you think there's a commitment at this point to really make a change?
Firstly, no, there is no commitment. But secondly, the argument that you are putting military spending against social spending is a problem in South Africa, and we see it across the world as well. You see it happening right now in the UK, where the Prime Minister that came in today appointed as his finance minister the former defense minister who resigned over this very argument. And the important thing there is reframing and helping people to understand that the defense budget is not money taken away from the social budget. It is part of the social budget. It is the 2% insurance policy that ensures the nation can sleep safely at night. That percentage that you put towards defense goes into paying South African salaries. It goes into paying South African companies to build South African weapons that keep South African citizens safe. It develops a state capacity that ultimately works for the greater good. It is not separate from human security. It is part of our national security.
Ricardo Teixeira, thanks very much indeed. Really appreciate the time. And defense analyst, there is so much to look at in our defense industry at the moment. 18 minutes after 7.
The Money Show, Africa Business Focus.
Professor Rotendo Ndingwi is the founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. How's it, Rotendo? There's so many interesting things going on at the moment. And am I pronouncing this company correctly? Metal, METL. They've got a big battery-grade graphite production plant going.
Good evening, Stephen, and good evening to your listeners. Yeah, so Metal is owned by Mohammed Dweji, who's a billionaire in Tanzania. And he's invested, he's always been active on the entrepreneurial fund, especially in big stakes game. And he's invested in a graphite production plant, Stephen. So not only the mining of graphite, but the actual production. As you know, graphite is one of those materials that is required with regards to investment in production of batteries. So it's quite significant, especially for an economy like Tanzania. The target, Stephen, is by 2027 to produce 50,000 tons of the product at 95% purity. He's looking at investing at $250 million, which is quite significant. And he's already quite a big player in terms of as a Pan-African MNC, that's METL or metal. There are 11 countries focusing on agri-manufacturing, logistics and financial services. So quite a good boost from a Tanzania perspective, and then East Africa and obviously the rest of Africa.
And then West African cocoa, that market, China is looking at that. Some of the tariffs have been repealed. I have to say, I mean, China and cocoa are not things that in my head have ever gone together.
I think if you China is always looking at something in terms of Africa. But I think why this plays a bit of a more strategic role, Stephen, obviously in the last few months, China has opened up zero tariffs for a number of product lines or import items from Africa, and cocoa is one of them. And Cote d'Ivoire and Ghana are sort of the biggest exporters of cocoa into the world. They own 70% of the market. But why this has got quite a significant inroad for both Cote d'Ivoire and Ghana and West Africa as a whole is that they used to be charged tariffs in terms of importing into China between 8% and 22%. Now with this 0% tariff that China has opened up, it makes their market very competitive. They used to export predominantly to EU and to the and to North America. So by now, the bigger market of attraction because of the removal of the tariff charges has significantly made their offering much more competitive, and they're targeting that market. Just to give you a quantum, Stephen, the output they're looking at doing per annum is about 4 million tons per year, and that converts to about $714 billion US. So it just shows with the global politics and geo-economics that are happening, things do change, and there's never a trade vacuum, and people will move to a more competitive market, and China has opened up for them in that way.
I mean, that zero tariff policy for them.
Yeah.
I mean, it's on paper great for African countries, but it also goes the other way.
Yeah.
And so, it makes it harder for you to compete with manufactured goods. And I mean, China's done it at exactly the right time when the Trump administration is doing their, stuff.
And Stephen, remember in the line of industrialization, the other thing China is now talking to the West African countries is actually building a processing plant of the cocoa in Africa and investing. So one of the big problems is that we've always been exporting raw materials. So they're also upping their games. Obviously, it's a long game, and time will tell. But if you look at it on paper, Stephen, they're doing it in the right direction, and it looks like it's a win-win. But as always, the jury's still out on this. But ultimately, a great opportunity for both West Africa and China on both sides.
In Malawi, the government there is partnering up with a private cancer center. And I presume, actually, many people who might have cancer in Malawi had no option but to go elsewhere before this.
Indeed. It was the normal story, Stephen, in terms of the health facilities were a challenge. But one of the local billionaires in Malawi, his name is Thompson Pingajira, has invested in a cancer facility. It's called the International Blantyre Cancer Center. He's partnered up with one or two local entities. And it's a great story with regards to it's creating for local health and affordability with regards to the locals in Malawi. The sad part, though, is that it was inspired because his wife passed away with cancer. There was not affordable healthcare at the time, and he stepped up. But ideally, Stephen, this is the kind of things that we need to do more of in terms of investing in local facilities, especially the people who've got the capabilities, who are Africans or who are established locally, and are doing things in the right manner. We know the sad stories of local people obviously having to go internationally to get medical assistance, and this is a step in the right direction, especially a country like Malawi, whose GDP per capita is low. This is definitely a step in the right direction.
The African Development Bank says Morocco ranks first in industrial development. Don't tell Parks Town.
Well, unless we're building aerospace manufacturing and automotive as well as phosphate. But Morocco has been stepping up in terms of the industrial index. It's leading at the moment. It's taking over South Africa. And then the reason is its focus on aerospace manufacturing, automotive space, and in the phosphate space are the key areas. In the automotive space, Stephen, they're manufacturing, or they're also assembling cars for Renault and Stellantis, which are key global players. So they're doing all the right things. And there's been a lot of, obviously there was a lot of hype around infrastructure development because they're hosting or they're co-hosting the next World Cup. But I think the big thing here, Stephen, is just that when you've got the right government policies that stimulate industrialization, attract foreign investment, but also support localization, all of these add up in the right direction. And Morocco has done this, and it's making the move in the right direction.
And then Cape Verde's Vozinha, this is a football team. This was the goalkeeper. He's been memorized in a really interesting way. Memorialized. What's wrong with me today?
Is memorialized. And I thought I'd finished with the soccer, Stephen, but this story came up. And for Zinia, which is actually his nickname, the Cape Verde goalkeeper, and it was after the draw that they had with Argentina, and a biologist named marine mollusk after him. His name is Jesus Ortega. So you've got all these different dimensions. Jesus Ortega, he's a Spanish biologist. After the game with Spain, Spain versus Cape Verde, he was very encouraged to publish and name the species of mollusk. It's about 4 millimeters long. It's a slug, and he's named it after the Cape Verde goalkeeper.
If you discover a slug, feel free to not call it after me. That's fine.
And it was named by Jesus Ortega, and it was a big thing. My question was that this happened, obviously the match with Spain happened in the group stages, so
Yes.
it wasn't, if it had happened like in the elimination round, I think it would be a different story. But after all of this, I mean, if you name a slug, and the person who names the last slug is Jesus, and he's Spanish, and Spain has just won the World Cup, and it's given to a goalkeeper, is the guy ever going to drop a catch? That's my that's my analysis on all of this. But all in all, a great story, named after a goalkeeper, and the guy did something memorable for the people of Cape Verde. So quite an inspiring story at the end of the day, Stephen.
Prof, thanks so much. Rotendo Ndingwe is the founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded.
The Money Show.
Personal Finance with Warren Ingram.
25 minutes to 8 the time. Warren Ingram's the certified financial planner at Galileo Capital. And tonight we're talking about why you can't avoid the scary moments in the markets. A scary headline can sometimes, in a way, kind of be the market's best day. Warren, good evening. So there have been plenty of scary moments over the last 5 years, and it's so tempting to get out of the markets. Tonight we're talking about the actual intricacies of this and why you can't do that.
Absolutely, and I think it's such a human emotion, and often, when our lives are threatened, it's a very good strategy, to avoid danger and get yourself, to a place of safety when you can, and that's a great way to survive. But in the investment world, that urge, and it's pretty primal, it's part of our lizard brain, is often the kind of drive that forces us to make decisions that actually act against our best interests, and something that I think we just need to pay attention to, and pretty apt time to talk about it because the world's in a scary place again, and both from geopolitics, markets, and the like. And I suspect that lots of people are feeling a bit unsettled, and so it's a good time to remind them that maybe it's time to embrace that sort of sense of fear and fight the lizard brain.
Okay, if you're wondering why we need to fight the lizard brain, why we need to stay invested, 011 883 0702 021 446 0567, and voice notes, of course, please, on 072 702 1702. Okay, so a part of this is about trying to time the market. You can see that bad things are happening. You want to keep your money safe somewhere, and then when it starts to rise, you want to buy back. Why is that so difficult?
You're forced to make quite a few decisions when you think you might just be making one. So the first decision, which is maybe the most obvious, is you decide to buy an investment, and you make your call, and it's a good decision, it's rational, everything's going well, and then life is trundling along, your investment's growing, and then all of a sudden the world gets a bit scary. And you look around and you go, hang on, this is not so fun. Maybe what I need to do is sell my investment now. And although I'm happy with it normally, I just shouldn't buy it or own it right now. And I'll sell it, and I'll wait for the inevitable to happen, the bad news to happen. Things will fall. The investment I want, that I currently own, it will then drop, and I'll buy it again, and then it will rise again. So the theory around that is pretty intuitive. It's something we all understand. The reality is much different because what happens is you've got to make 3 almost perfect decisions just to try and get one thing right. The first is you've got to buy a quality investment at a low price, and you've got to let that grow so that you make money. But now you decide, well, hang on, this quality investment might fall. So you've got to sell it before the crash. So that's the first decision you have to get absolutely right. And then you've got to hope that when it falls, you're fast enough to buy it before it recovers again. And so now you've got to get two decisions perfect in a row. And history shows that it's a very nice concept on paper, works perfectly in every textbook ever written, but in the real world with real money, almost nobody gets it right. And if they get it right once, let's say some famous trader gets it right in 2008, the next big event, when you think they know how to do this, you realize they don't, they get it wrong. So what happens is we put the experts on a pedestal and failing to understand that they were simply lucky the first time around.
Okay. And then the other thing is that you don't know when the biggest up day will be and the biggest down day will be. But if you just look at the JSE over the course of a week and look at the biggest rises and fallers over the course of a week, those days are often very close to each other. They actually happen in the same period sometimes.
Yeah, so it's astonishing research. Often you'd think, well, the really good days in the market, and to give it context, a really good day would be when the market jumps by more than 5%. That's an astounding day, and sometimes it'll go up by 9 or 10%. And you would think that those are the days that happen when the world is incredibly positive, when people are just so happy and economies are booming, interest rates and inflation are low, and we're all just monumentally positive. And then we get an astoundingly good day. That's not true. What generally happens is the best days in the market, when you get a 9% or a 10% jump, happen after the market's been absolutely smacked and people are desperately fearful. The headlines are blood on the streets or something, equally dramatic. And then all of a sudden, a bunch of investors almost randomly look around and say, well, hang on, there's some really quality things out there that are trading at almost no price. They're incredibly cheap. I'm going to buy. And then you get one of the best days in the market. And the problem is you need to be in the market on those days. And the only way you do that is to embrace, those lousy headlines.
Okay. I mean, obviously you want to miss the bad days. What happens if you miss a few days? I mean, I presume there must be consequences to that. You can miss just a handful of days. What would happen?
So let's talk about missing the best days. So now we've established that those best days happen in really bad times when everybody's really scared. Now, over a 20-year period, and 20 years, is roughly 5,000 days. So it's quite a few days. If you miss the 10 best days out of that 20-year period, your returns generally are about half of what they would be if you just bought the investment. So let's just say we talk about the index. You buy the index, you do nothing, and you invest your money. Let's say it's 10,000 rand. You put 10,000 rand in the index, and you let it ride for 20 years. So there's lots of crashes and booms and all sorts of scary headlines all along the way, but you do nothing. Your 10,000 rand after 20 years will give you round about 65,000 rand. So nice return. You did no work. You didn't have to trade or make any decisions, but you missed the 10 best days in that 20-year period. Your return's going to be about 32,000 rand. So not even half. And just think about that. How is it possible to be so accurate that you're going to get 10 out of 5,000 days? So the answer is you can't. And now you've halved your return. So you have to embrace I guess that's the message I'm really trying to land, is about the best days are amazing days to be invested. The problem is they happen when things are really not going well everywhere, and everybody's shouting at you, from the media to your friends to your stockbroker, everybody, your mother-in-law's even telling you that things are going bad. Your hairdresser's telling you it's time to get out. And then the best days happen, and you've got to be in them to get that return of the 65,000 and not the 32,000.
So, I mean, just in a calculation of 5,000 days and 10 days, I mean, you're just not going to get that right. No one in the world's going to get that right. That's why trading is so interesting, I suppose, is because it's impossible to get that right.
Yeah, and I think a lot of people would now say, well, hang on, I'll just create an AI bot and it will do it for me. The difficulty you've got is that eventually, unless all markets are only run by trading bots, if there are humans involved, you have to account for the irrationality of the crowds, the madness of the crowds. And that's the thing you can't calculate. So that's the problem with investing, is it is going to be irrational in the short term. And how on earth are you going to get 10 days out of 5,000 right? How are you going to predict that? And I just don't think it's possible.
Okay. I mean, I'm fascinated by the fact that the bad days and the good days happen so close together. But I suppose if you think of some of the more frightening things we've seen, there's probably an important reason why that happens.
Yeah, and so one of the ways to kind of turn this on this head, which is what some people would do, is say, okay, well, hang on, why don't I just develop a strategy rather than, instead of trying to aim for the best days? You've just said that that's really not possible. And maybe someone buys that point. Why don't I then just kind of avoid the worst days? Now your problem is that the worst days are almost side by side with the best days. So when you're in, like, I think a great example is the COVID crash. It's something that was entirely a shock to the system. It wasn't driven by inflation. It wasn't driven by overvaluations. It was a pandemic that just flooded the world at really short notice. And markets, fell incredibly quickly. And so you can't just avoid the bad days, because they are going to be a surprise. I know we had this conversation early in the year about valuations, and you could say, well, hang on, sometimes, we know bad days are coming because valuations in markets are high, and that's a more predictable kind of a thing. Okay, but you can't forecast a pandemic. You can't forecast a big war or a terrorist event or something that causes huge market events. And so you can't, unfortunately, avoid all the worst days either. And then remember that, when the worst days happen, they're right next door. If they were kind of people, neighbors, they would probably rock up at the same party. They are just hand in glove together.
Okay, so if you look at what happened during COVID, everything fell and everything jumped all at the same time, and that's just the way it goes. So then what do you need to do yourself? So markets will be falling. You will start to worry about that. Everyone will be saying, your spouse who you share your money with will be saying, get the money out. What are we going to do? How do you manage that?
I think firstly, understand it before you allocate money to investment markets. So you've got to know that volatility, which is just a fancy word or a fancy way of kind of saying the roller coaster ride. It's a condition of markets. You can't get opportunities for investors to buy things at a good price, especially quality investments, if there isn't volatility. If everything's stable and predictable, then you're not going to be able to make, good capital growth over long periods of time. So embrace the volatility before you invest the money. If you're investing as a couple, as a team, look each other in the eye and say, we do this and we don't sell when the news headlines are scary. We're going to remember this thing of 10 days out of 5,000, and so prepare yourself for that and say, okay, the deal here is, my job as an investor is choose quality investments and then stay the course, stay invested. And most especially, if the markets do have a big hiding, and you're a monthly contributor, you do a debit order into your investments, or you invest every 6 months, or whatever the deal is, whatever your pattern is for investing, keep going. What you need to make peace with is that what you're probably doing is buying a very high quality investment, and it's now a third of the price of what it was a little while ago. So don't now get suckered into the headline fear and say, well, hang on, maybe I'll just store the new investments and I'll wait till things get better. You actually, the headlines are giving you the opportunity to buy fantastic investments at the moment when everyone else is selling, which means you're getting the deal. And that's why, I always think, when we talk about things like tax-free savings accounts, unit trusts and retirement funds, the discussion is always, these are long-term investments. So understand that long-term investments are designed for decades of growth. That's how you compound. You've got to allow the money to work for you, and that means You look at volatility, and if you're a saver and an investor, you should kind of be smiling a little bit to say, okay, there's volatility, there's a lot of noise and a lot of fear on the streets. What I'm going to do is I'm going to try and become a buyer of everyone else's panic selling, and I benefit when I look back in 5, 10, and 20 years' time. But what I shouldn't do is fall victim to all of the fear mongering that causes me to sell the quality thing at the wrong time.
And I mean, I suppose if you stay in over a long period of time, you're the ones who create wealth because you've kept the money in one place.
Yeah, and I think it's that, go back to do you want the 32,000 or the 65,000 over exactly the same amount of time with exactly the same amount of money invested? And so, we kind of know it as an academic concept that, that people, when you put them in a large group, and the largest group I can find is the stock market. People tend to behave badly. They don't behave rationally, etc. So rather than fall foul of that madness of crowds, say to yourself, I'm the exception. The superpower I've got is I can't be cleverer than everybody else. I can't second guess all the big financial institutions and fund managers and buy better investments than they can. But what I can do is buy quality investments, potentially the same ones that they've bought. But I can stay invested when they fall subject to the panic, and I can carry on because I've got a game plan, and I can do that without having to worry about everybody else. And that's the secret to building real wealth, is not running for the exit when everyone else does. In fact, you should be running into the madness to keep buying.
Sure. I've got an email earlier today from Colleen. Colleen emailed me at Stephen@702, and she said, "Dear Stephen and Warren, I have learned so much from your show. I'm pleased to say I now save every month, and I understand quite well how to increase my tax efficiency. I suspect my question does not have one simple answer, but I'd love some guidelines. I do my best to maximize my RA contributions each year on an investment platform. The problem, however, is that there isn't just one product to choose from. There are interest and money market funds, balanced funds, all the way to pretty much all equity. Similarly, some are more offshore than others. I can see there are limits, for example, to how much equity one can have and how much offshore, etc., but those are just the upper limits. I'm not sure exactly where one should be relative to those limits. I was wondering, is there some guideline as to a kind of percentage breakdown we should aim for? If it helps," says Colleen, "I'm about 8 years off retirement age." Colleen, it's a great question. Thank you for emailing me. We'll have an answer for you from Warren in just a moment. 9 minutes to 8.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
7 minutes now to 8 the time. Warren Ingram, of course, with us in Personal Finance. Colleen's question, Warren, trying to maximize my RA contributions, their interest in money market funds, balanced funds, all equity. Some are more offshore than others. I'm not sure where one should be relative to the limits. Is there some guideline, a kind of percentage breakdown we should aim for? She's 8 years off retirement age. Warren, please, some wisdom for Colleen.
I love the question. So I think the one key piece of information here is the 8 years, because let's just say Colleen doesn't specify, but let's assume Colleen's going to turn 65 in 8 years' time. That's already getting into long term, and that's important because when you've got 8 or 10 or 15 years to invest your money, and why I'm mentioning longer than 8 years is because Colleen's not dying in 8 years' time; she's just retiring. Her money still needs to keep working so that it can provide her an income for her whole retirement, and so her time horizon's probably at least 8 years plus, let's say another 30. And in that instance, you should be looking at this and saying that's a long-term investment. And that means I need quite a big exposure to the stock market so that my money can grow faster than the inflation rate. So number one, you shouldn't really be looking at those lower risk investment options, let's say like the money market and the interest funds. Those have a different role to play. They're great for emergency funds. But when you're trying to grow your capital faster than inflation, you need a large exposure to shares. So you're looking at the category of unit trusts called balanced funds, and they're very good from the point of view that they'll often invest probably close to the maximum limit, somewhere around 75% in stock markets, and a lot of them would have somewhere around 30 to 45% in international markets as well. So you're getting a very good spread of local and global investments, and then high exposure to shares, but they do balance it out with some exposure to the bond markets and some exposure to cash and maybe the odd property company as well. So I think that the guideline here would be, you've just got to be comfortable that a high exposure to shares means lots of volatility that we've spoken about on the show. But if you can deal with the volatility, you do get very good inflation protection from having that allocation to shares over a long period of time.
So, I mean, it's just a reminder that volatility matters. Without volatility, you're not going to grow your investment. It's a key ingredient.
Yeah, I think, we would all love stability. It's human nature to want calm and stable and safe. And that's great when you're building a house, for example, or a good ship. But what you don't want to do is have a very safe, stable investment, because what it's guaranteeing you is that it will probably perform just below the inflation rate, which means your money doesn't grow faster than your cost of living. And so you have to deal with that volatility and almost take comfort that if you've got volatility, you've got a chance of doing better than inflation. And that's really the enemy you want to fight when you're dealing with your retirement capital.
Okay, so we were talking about what to do on the scary days. And our sort of end point on it was the people who create the wealth are the ones who are able to sort of stay invested in the same thing for a very long time. But there are moments, and Warren, I mean, I agree with you. I think there will be moments fairly soon where you sort of look at it and you go, gosh, I think I need to do something. I can't stay like this. So then what should we do?
The first thing is maybe just take a break from kind of your media consumption, especially like the social media, engine that's feeding your fear, and just set that aside for a second. If you can, kind of have a conversation with people that a person or some people that you respect who have a kind of fairly calm head and fairly clear-headed and clear thinking and rational, and then go and look at your investments that you have got invested and just make sure that these are investments that you can leave in their respective portfolios for that period of 5 or 10 years, and then ask yourself the question: if I've got 5 or 10 years, let's say it's 10 years, I've got 10 years to invest, and my portfolio goes down by 30% in the next week. 30% is a radical drop, but if it does and it recovers by that 30%, in 2 years' time, what's really changed in my life? And if the answer is nothing, then leave the investments as they are and let them be, let them do their job. But if you're going to need the money in a year's time, then it shouldn't be in the market anyway. You should start changing that and putting it into money market accounts or something. So I would say that that's the biggest thing you should do. And then if you are doing debit orders, keep the debit orders going when things get scary and take advantage of the sale that's on offer when it happens.
And if you feel the urge to sell everything, do you need to just count to 10 and listen to Warren?
Yep. Please go and get a recording of this show and play it to yourself again, because doing nothing, it seems like a lazy thing to do when you're building a house, but often doing nothing when you're investing is probably the best thing you could possibly do, and it's an intelligent thing to do and very hard for most people to actually action.
That's why we try to just cover our eyes sometimes, give it to someone else to manage. Warren Ingram, thanks so much. Really appreciate it. The financial advisor and co-founder of Galileo Capital. And of course, this will be put together as a podcast for you in probably about half an hour or so from now. I'm sure it will be available. But the lesson, of course, as always, is without the volatility, there won't be any growth in your investments. And if you don't have the growth, you won't be able to get an investment that returns higher than inflation. That's really, I suppose, the lesson from all of this.